Okay, good afternoon, everybody. Thank you for joining us for this, our second in our Funds Week program that we've been hosting. My name is Mark Muller. I am a director of Sanlam Private Wealth in Mauritius. However, I'm coming to you from the lovely country of Kenya in the Great Rift Valley, where I've got stuck in transit due to the various COVID lockdowns. And so just to show you the global reach that we have as Sanlam, we've got Mike, who's a fund manager from London that's dialing in. We've got Amri Pitot in the background, who's running the magic for us, and all the way from Mauritius. So, Mike, thank you once again for agreeing to address us. Much appreciated. Just some housekeeping before I hand over to Mike. Mike's presentation is going to be 25 to 30 minutes long. If there are any questions pursuant to Mike's presentation, please send those through, and I'll happily pass those on to Mike. And those that we don't get to, we're quite happy to answer those and ping you later in an email. Mike, you will notice that the last time you and I spoke, you said the only criteria to be joining your team is that one must have a beard. And since that, Mike, I've worked hard on this. So my CV's in the post along with a photograph. I didn't shave this morning particularly for this presentation. But all jokes aside, Mike joined Sanlam in January 2013 to develop a multi-strategy proposition. He previously headed up the multi-asset group of Insight Investments and spent 20 years at Credit Suisse, where he held senior positions, including head of special mandates and head of trusts and charities in the asset management and private banking divisions. Notably, Mike was awarded the title of Investment Week's Fund Manager of the Year for 2018. Now, on a personal note, Mike has traveled with us a lot. And for those of you dialing in from all over Africa, will be familiar with Mike and his presentations. And Mike is a great friend of Sanlam Private Wealth in Mauritius. So, Mike, thanks once again for your willingness to address us, and we look forward to hear the latest on your funds. So, Mike, without further ado, over to you.
Okay, thanks for the intro. I'm sure that the potential pool of talent over lockdown around the world, I think there's more beards now than there was 18 months ago. That's for sure. But let's get on with the presentation. So we've got half an hour or so. So I'll try and get to the interesting part. So I'm just going to share my screen. Hopefully everybody can see this. Bear with me 1 second. So hopefully that's everyone can see the screen. So we've got your half an hour as an introduction to the funds, and perhaps a refresher for some people. But I'll try and move along at a fair pace and hopefully get to the questions. I won't spend any time on the Sanlam piece. Sanlam here in the UK operates essentially as a multi-boutique structure. So all of the specialist teams, some of them I think there's some people you know. So the teams have autonomy in terms of how they run money. We sit under that very nice umbrella of Sanlam, but effectively, we are boutiques with a vested interest in making sure that our businesses perform as expected. Team-wise, again, I won't spend too much time on this. For my sins, this is now 32 years in finance, 32 years in asset management. I joined Sanlam, as Mark said, in 2013 to build a multi-strategy business. Johan came with me on day one. Chris joined us about 5 years ago, and Josh 2 years ago. So 4 of us on the team, very experienced. And these 2 funds is our only responsibility. We don't have any other tasks other than running these 2 funds. So just to dive into where we started, in the intro, as Mark mentioned, I spent 20 years at Credit Suisse, so a huge amount of time with private clients, with institutions as well. And it struck me that every client I've met at that point, a 20-year career, had a pretty simple task for guys like me, which was essentially, you go and make me some money. And there's often a second part to their requirements that they forget to tell you. And of course, that's if you can't make money, then don't lose it. So I built the multi-strategy fund, blank piece of paper with that philosophy right at the heart. So I describe it as you participate when you can and defend when you need to. And that is essentially what the multi-strategy fund is designed to do. Now, that's a difference from make money in all environments, because I think some of you may have heard me say this before, but I think that's a bit of a fantasy mandate. Sometimes markets move very quickly and it can be very, very difficult to always make money. But I think it is perfectly capable for managers to defend the downside, so to be very disciplined in terms of managing risk, but also to make sure that they participate when markets are conducive to making gains. So it's an absolute return fund. As the name obviously suggests, it's multi-strategy. We concentrate on equities, on fixed income, and on real assets. Other alternatives is generally a hybrid of one of those three. The universe is global. The portfolio produces income as well as capital growth. Most investors, obviously, you have an accumulation unit of shares, so all of that contributes to the total return. Short-term target positive, so on a rolling 3-year basis, we'll try not to lose money. Longer-term target is to basically to grow our investors' money in real terms. We launched the fund in 2013. We actually launched the fund without any seed capital. In fact, it was mainly our own money to launch the fund, and we started with about £1 million back then. We've really established the portfolio within Sanlam and within the marketplace, and currently so £430 million or $600 million. It's a daily traded fund, so everything is liquid. We do have the fund in 4 currency classes, and the only thing to mention here of note is that we hedge on the currency. So if you're invested in the dollar class, you don't have exposure to the sterling or to the euro. It's just dollars. And if you're in the sterling class, you're just exposed to sterling, and so on and so forth for Swiss francs and euros. So essentially, we're not taking currency risk within the fund. Dublin UCITS, management fee 75 basis points. There's no performance fees. There's no entry or exit charges. So fairly straightforward UCITS. The real asset fund came about. It's been part of the multi-strategy fund since we launched. Several years ago, now actually 3 years ago, one of the largest institutional teams within Sanlam in South Africa was an investor in the multi-strategy fund, but said to us, look, I like what you're doing in terms of the absolute return space, but if I'm honest, the strategy that I get excited about is your real asset strategy. So that institutional investor asked if you have that strategy on a standalone basis. So we took what we were doing in the multi-strategy fund, and we launched just the real asset component on its own. Now, originally, he was a segregated mandate for $50 million. We then launched the fund, and he converted that segregated mandate into the fund. And then once the fund was up and running, then we offered the fund and made the fund available to everybody. And again, very similar story to the multi-strategy fund. We started with a fund, relatively small amount of assets, and we've grown quite nicely. So 350 million sterling, just under $500 million now in the real assets fund. The real asset fund's aim in the long term is exactly the same as multi-strategy, which you'd expect, as they are component parts of the bigger strategy. And that's to produce a long-term return, which is over and above inflation. So inflation plus 4 is the long-term target. This style, it is an equity fund, so it's not an absolute return fund. It's a thematic equity fund. The focus, as the name suggests, obviously real assets, but in particular infrastructure, renewable energy, specialist property, and other alternatives, things which you may have heard me talk about in the past, things like music rights, as things which are long life real assets, but just less traditional. And again, Universe, obviously global, produced both capital returns and income. The yield on the fund is about 3.3% at the moment. We have 40 holdings. The focus is very much long term. So we're investing in long life assets. So it makes a huge amount of sense to look and have a long term time horizon. As before, the fund is a daily traded fund. So long life assets, but it is a daily liquid fund. Same in terms of currencies hedged, same in terms of costs. Just in terms of track record, and I won't spend too much time on this because most people have got their own databases you can check. But the multi-strategy fund, if we look at the fund in the Morningstar universe, it's about 450 competing funds in that space. And I'm pleased to say that we have first quartile performance over every period, 1 year, 2 years, 3 years, 5 years, and since inception. So we've got a strong track record, which is very pleasing. The real asset fund track record isn't quite so long, but again, over the periods that we've got, it's a first quartile fund. I won't spend too much time on performance. You'll undoubtedly run the numbers yourself, but generally speaking, nobody's moaning at me, and that's a pretty good sign that performance is okay. So just a sort of a look through into the strategies and the process. The multi-strategy fund, as I said, has 3 component parts. We have a global equity strategy, which is systematic, so it's a rules-based strategy, and we invest in global equity indices. So we'll buy the S&P 500, we'll buy the FTSE, we'll buy Euro stocks, the Hang Seng, the Nikkei. So we're only invested in indices. We're not taking any single company, single stock risk in that space. So super liquid portfolio. Sitting below that is the real asset component. Here as a thematic strategy, concentrating on real assets, and I'll add some color to that in a moment. And then our fixed income strategy, which is essentially a ladder portfolio. So the bonds really providing the foundations, the base of the portfolio. It's a very boring strategy most of the time. Occasionally, it can be quite interesting. But again, I'll add some color as we go. So essentially, the multi-strategy fund is a combination of all 3. The real assets fund is just that real asset strategy on a standalone basis. How we think about the portfolios in time horizons, and again, just that clear distinction between an absolute return fund where we do think about you managing the downside risk, the short-term downside risk. We use short duration bonds. It's an equity momentum strategy, so very dynamic allocations in terms of equities. We use option overlays again to enhance the income and reduce the risk. In terms of the liquidity profile, it's a very flexible strategy. So again, liquidity in those equity indices, those equity index futures, very, very liquid portfolio. And then your real assets, again, as a component part, but and on a standalone basis, it's a long-term strategy. It's the long life assets. And again, if you're thinking about your risks in the long term, you really have to be thinking about inflation. And that's obviously a very topical discussion at the moment in terms of what are markets doing? Are we moving into an inflationary environment, or indeed are we just seeing some of the recovery from lockdown coming through as some of those sort of short-term transitory inflation marks? Just looking at the individual strategies in a bit more detail. The equity strategy, I said, is rules-based. So this is a very dynamic element of the multi-strategy fund. You can see that last year, going into that Q1 downturn, we were running around about 30% net equity exposure. and as the markets, you sold off, as markets came under pressure, then we will de-risk the portfolio. So, so you can see that quite aggressively, we cut our equity risk, and we cut it from, as I say, 30% at the high, actually down to -10 at the low. So we de-risked the portfolio, we reduced the risk, and once we'd reduced the risk, we then turned our attention to looking for opportunities. And it's always much easier to take advantage of the opportunities that are presented when you're sat in a position of strength. So we bought call options here to give us that upside participation. We also took advantage of the higher bond yields on offer post the sell-off, and we put that to work. And of course, what you saw in the rally was, as markets started to recover, our equity exposure very quickly accelerated back up. So during last year, we had a much lower drawdown than broader markets. And what was particularly pleasing from my perspective was that actually the multi-strategy fund hit new all-time highs before equity markets did. So again, it really pleased me that it was aligned with that philosophy of you participate when you can, but we defend when you need to. In the last year's case, we defended well, and because we defended well, it made it much easier to go on the attack. So the equity component part, very dynamic, but again, really you're designed to make sure that we deliver on that promise of being a safe pair of hands when we need to, but also participating when markets present opportunities. The real asset portfolio is obviously a component part of multi-strategy. It's about 30%, but the thesis behind real assets actually, it's something we've been investing in since 2006, but it was actually 2015 where we really started to concentrate on the importance of real assets in navigating the current environment. And that really goes back to, if you recall, back end of 2015, we had a very sharp sell-off in markets. From memory, it was about an 18% sell-off. And then the Bank of Japan announced a QE program. Now, I've been in the market since 1989, and that Japan really joining the fight and really sort of pumping stimulus into the system was a light bulb moment, where we suddenly realized that the level of intervention by the authorities was huge and it wasn't going away. And so running an absolute return fund, we asked ourselves, how can we navigate this market where there's so much intervention that it really makes it very hard to take a view of the uncertainty, both upside uncertainty as well as downside. The markets were being manipulated. And so we started to concentrate on what we felt were long-term themes. And it evolved into what we describe as the pillars of a functioning economy, which just put very simply, what does an economy need in order to be successful? So whether it's education, schools, people capable of doing the jobs that need doing, housing, because those people have to live somewhere, transport, they need to be able to move from where they live to where they work to where they study. These are just basics. Healthcare systems. Some of you may have heard me you speak about the healthcare system in the UK. Now, pre-COVID, the health system in the UK was the 5th largest employer in the world. The National Health Service here employs over 2 million people, and that's a pre-COVID number. Pre-COVID, the budget for the health system in the UK, if it was a country by GDP, it would rank somewhere between the 50th and 60th largest country in the world. And again, that's pre-COVID. So health systems are incredibly important to an economy. They're incredibly important to an economy because you need a healthy workforce. That's why governments have been so keen to lock down and to defend their health systems, because when we eventually emerge from COVID, you need workers who can go back and do those jobs. energy, food, water, again, just basics. And so we really felt that one of the best things we can do to navigate this short-term uncertainty, and that was 2015. Look at the level of intervention today, and I mean, you can magnify it 5 times. The level of intervention is huge, and it just convinces us that concentrating on, as we do, operational long life assets, assets where there are contractual revenue streams, preferably with inflation linkage. That means we can take a long-term view and we get paid along the way. And that just for us seems to be a very sensible way to invest in a period of extreme uncertainty. Everything we invest in is listed. So although we're investing in those real assets, you're not buying a building or a school or a road, and that's where your liquidity comes from. Your liquidity comes from the stock market because everything we own is listed. What we particularly like is businesses that have a private equity style of management. So it's essentially safe, long life assets, but quite dynamically managed. It's been a very fruitful combination for us here since those first investments back in 2006. Just on our process, so everything we do, we do in-house. So that your 4-man team, all of the idea generation, all of the research is done. You're on the desk. So every time we see an opportunity, every time we go through our research process, if we learn something new, we learn it across the entire portfolio. We're always looking for opportunities that align either directly to our themes or indeed that align to some of the supporting factors, such as demographics. Whenever we find something, we'll go through a process where we look to create what we call a base note. That base note really gives us, to the best of our ability, an understanding of what this business does, where the risks are, where the opportunities are. But more importantly than that, that base note then forms the basis for all future engagements that we have with the management team. If there's any corporate activity, any announcements, we always ask ourselves, okay, is this what we expected? And that's absolutely vital because every investment that we make, I'm looking to make a long-term investment. So I've mentioned a couple of times the first investment I made in real assets was back in 2006. I own that company in every portfolio at Credit Suisse. They still own it today. When I joined Insight, I bought it on day one. They still own it at Insight today. And when I joined Sanlam back in 2013, the first 2 investments that we made when we launched the fund, I still own today. So when we're looking for opportunities, what we're really asking ourselves, is this a business that we can own for 10 years plus? So we really want to have a very close relationship, a very good understanding of the management team, and we're going to have that for a very, very long term. So a successful position for us is something that we bought 10 years ago and that we still own today. An unsuccessful position is something that we bought and we don't own it any longer. That generally means it hasn't gone according to plan. It doesn't happen too often, but that's a simple measure of success and failure for us. The portfolio, obviously, those opportunities are global. Currently, we have 64 different asset types spread across 60 different countries. Now, we're interested in operational assets and obviously assets where we can access through a listed vehicle. There is huge, as I'm sure many people on the call know, there is a huge amount of development taking place across Africa. But obviously, what we need is completed assets, and we need assets where we've got that sort of certainty that it's still going to be around in 30 years. And of course, we need that in a liquid, hopefully listed vehicle. So at the moment, we've got good coverage. Given that we're long-term investors, as time goes by, I'd expect to see more of the gaps eventually filled in around the world. But again, we look globally for those opportunities. Just to the bond portfolio. So back just to multi-strategy. So obviously in multi-strategy, you've got the very dynamic equity allocation, you've got the real asset component, and then you've got the base case of fixed income. And in the base case, you're fixed income. Essentially, I say we run a ladder portfolio. Your bonds mature, we roll them forward. So typically we buy bonds, we hold them to maturity. Occasionally, bond markets present opportunities. That was the case in Q1 last year. We saw a massive widening of spreads. So that enabled me to extend my duration. I moved the duration from 2 years out to 3.1 years, and we locked into those higher bond yields. And now the opportunity has gone. Those bonds that we bought yielding 4.5% plus are now back yielding 2%. So we're going to continue to just clip our coupons and wait for the next opportunity to present itself. So generally speaking, bonds really boring most of the time. Occasionally, you're quite interesting. We just have to be patient. Just the shape of the portfolio. So actually, end of the month or start of the month, you're about 30% equities. That number's you're a bit lower today, just over 20. The fixed income component is 64, and real assets is 30. Now the eagle-eyed amongst you will work out that is more than 100, and that's of course because we're only trading in the equity space. It's only index options and index futures. So the fixed income component is effectively the collateral that sits behind the equity risk. So there's no gearing in the portfolio. So anything we've got on the equity front is backed by positions in bonds. The characteristics of the multi-strategy fund, just to put in context, in the multi-strategy fund, you've got the base of the portfolio, the foundations being that fixed income portfolio, boring most of the time, occasionally interesting. Then on top of that, you've got real assets. So the foundation part is that you're very secure, quite boring portfolio. And then on top of that, you've got your equity allocation, which is quite dynamic. So you've got sort of equity optionality. And when you combine that really strong base with equity optionality, you end up getting a strategy that's got the profile of a convertible. So if you just think about the philosophy behind the fund, participate when you can, defend when you need to, what that really translates to is in the event that it's a defend year, we need quite a defensive portfolio. So in that environment, a defend year, it's the bond element and the fixed and the real assets element that is really where our portfolio tilts towards, because we're not going to get much from the equity piece. In the participate year, we continue to get the base return from the foundations, but of course we get the kicker from the equities. So it's not a bond fund, it's not a convertible fund, but the characteristics, it means that we can approach whatever the environment is, whether it's a participate year or defend year, but we approach that with a high degree of certainty that the fund is fit for purpose. Real assets, the structure, so 30% in infrastructure, just under 29% in specialist property. So specialist property would be things such as data centers, distribution, warehouses, so Amazon, your centers, student accommodation, private rental housing. So we don't own shopping malls, we don't own office blocks. Everything is a specialist property, and in fact, the performance of the property element has been very, very strong. Those specialist areas really haven't had any of the problems that you've seen in shopping malls and office blocks. Renewables, 25%, so solar, wind, onshore and offshore, hydro, anaerobic digestion, and there's quite a lot of work being done in terms of hydrogen at the moment. So we don't have any direct hydrogen plays, but a number of the larger companies that we've got are testing hydrogen technology. So essentially, you're putting a hydrogen electrolyzer next to an offshore wind turbine, and when you've got surplus power, using that surplus power to create hydrogen. So it's definitely a space of future potential growth. Just on geographies, 40% in the UK, but please remember we hedge currency. So you're not exposed to sterling. What you're exposed to is assets in the UK, and the UK is a very, very good place to own long life assets. We've got a very strong legal system, very strong sort of title ownership, very established market for investors in infrastructure. When we launched the fund, we were actually about 60%, 65% UK, but just increasingly we're finding more and more opportunities on the international front, which just again signs of the increased importance of those pillars around the world. And again, just again on characteristics, just highlighting the fund. So you can see the returns since inception. You can see the best months and the worst months. So you can see that you're significantly your different pattern of drawdowns. You can also see the days to recovery. So as you'd expect, the multi-strategy fund recovered much quicker than the real assets fund. And if you look at volatilities, again, the real asset fund had a much lower volatility than global equities in general, but still you're quite a bit higher than the absolute return fund, which again, volatility of less than 5. But again, just give you a feel for the types of characteristics that one would expect between the two funds. Outlook, I'm doing okay for time. I think I'm just coming up to half an hour, so I'll just give you the sort of broad outlook, and then I'll summarise and open up for questions. So look, I'm not a big fan of forecasting. I reluctantly write an outlook once a year, but I wrote this in December, and I think already we can see some of the thoughts unfolding. From a general positioning perspective, from a multi-strat perspective, as we've done since 2015, we're just going to continue to run the portfolio with that convertible profile. So we focus on real assets, we focus on short duration bonds, and a very dynamic equity place. Whatever the market throws at us, I think I'm quite comfortable that we'll navigate it. In the real asset markets, again, it seemed to us, again, 5-6 years ago, that real assets were a very sensible way to navigate a period of uncertainty. When I take that thought process and I look where we are today, I think the level of intervention is even greater. The authorities around the world are trying to manage COVID. They're trying to manage inflation. They're trying to manage your job losses. The amount of and you can throw the environment as well in there. The amount of areas that the authorities are trying to manage is vast, and it makes it very, very difficult for investors to navigate through. So that we think that the best thing to do is to just think about some of those longer term trends, the need for education, the needs for housing, the needs for transport, the needs for clean energy. Concentrate on those and get paid along the way whilst the madness in the short term plays out. We'll be sat in very secure long life assets. I highlighted just a couple of focal points, and again, I just stressed that I did write this mid-December. I think global trade, again, it will play a bigger part as we go through the year. I highlighted life after Brexit will keep trade in the high. And interestingly, I highlighted that food security, vaccine distribution could become hot topics. I clearly had no idea that vaccines were going to become quite such a hot topic. But it just seemed to me as part of this sort of deglobalization, as part of post-Donald Trump and post-Brexit, where countries are looking a little bit more inward, it almost seemed inevitable that there was going to be some tension, and sort of food and medicine is an obvious place. So I won't claim to be too insightful, but so far that's playing out. Stimulus packages are huge. We are definitely all living on the government ticket. But the point to note here is that a lot of the government stimulus policies are now coming with environmental criteria. So hugely supportive for areas such as social investment, social housing, etc., and of course for renewable energy. I think that's not going to change. And then the big question in terms of valuations, markets have run pretty hard in anticipation of recovery, but as yet, we need to see that come through. So some of the valuations, look pretty stretched. So again, the best advice I can give to anybody, and indeed the course we're taking in the fund, is think quality and think long term. That for me is the best way to navigate this period of extreme uncertainty. So then just to sort of summarise the two funds, then I'll open up for questions. Look, I think the current environment presents investors with a big challenge, and I think that the thing that's needed more than anything else is a really clear understanding of the characteristics of where you're invested. From my perspective, I have two funds. I have an absolute return fund where we actively manage the downside risk in the portfolio. Now, we will hunt for opportunities, but again, the mandate is to make sure that if markets take a turn for the worst, if we start to see significant downside pressure, we will actively manage the portfolio to reduce the downside risk. Now, if, however, you're prepared to accept some of that short-term volatility and actually say, no, look, I'm quite happy to look through the volatility, then I think real assets is an excellent place to be. We can't avoid some of the market volatility, but what we can do is make sure that we've got a high quality portfolio that's producing that sort of near-term income stream, and that should give investors the confidence basically to wait out the volatility that may or not be there. So two very different approaches, and just really a case of having very clear characteristics around what each one of them does, and then ultimately I think it's best investors choose which one is right for them. So look, I just summarise. We are a pretty experienced team. We've been around a long time. We've been doing this now for a long time. We have a track record that's, I think, is pretty strong. I don't really like to talk about it myself, but I have to occasionally. And again, in terms of alignment, so all of the team are fully invested in the fund. In fact, for me, I don't have any other investments outside of multi-strategy and real assets other than my house. And again, the same is true for all members of the team. So we are most definitely eating our own cooking. Mark, Amir, I'm going to stop there if that's okay. But I'm open up for any comments or questions anybody might have. I'm going to stop sharing so I can see everybody. If that's okay.
Thanks, Mike. That was great, Mike. I'm not as shy as you are to speak about your achievements. You can go, and for those who are interested, you can go and look at Mike's many accomplishments, including Investment Week's awards and so on. So Mike is a multi-award-winning fund manager, and we're very pleased to be having Mike. There it is, right behind him. We're very pleased to be having.
Yeah, there's a few of them knocking around, but yeah, I think that is one of them. Anyway, hey ho.
Very pleased to be able to work with Mike, and for those of you who've had the pleasure of seeing Mike in person and dealing with him, he certainly knows what he's speaking about. So, Mike, I wanted to just speak to you about on the real assets, just a couple of questions that we have. And I'm going to focus for a bit just on the real assets fund, Mike. It seems all in vogue now with the Biden administration announcing a $3 trillion spend on infrastructure, which is going to be funded, it seems, by a bit of a tax hike for companies and higher income earners. That is along with the Biden administration's campaign promises of focusing on renewable energy. That seems to sit very nicely with where the Real Assets Fund has positioned itself. How do you see that working out for your fund?
Well, I think just a bit of background. Firstly, I think it's great news. So we've been in this space for a very long time, and in the last year, lockdown, change of administration. We're actually seeing almost as if the world woke up to something that we've been doing for a long time. So it's great news, we think. Now, there's a bit of time frame to take into account. I'm interested in operational assets as opposed to assets under construction. So the big gap that has existed for the last decade or more is that governments around the world have needed this infrastructure investment, and institutions want to own long life assets that produce income, pension funds in particular. The problem is nobody really wanted to take the construction risk. So there was a bit of a gap between, it makes a huge amount of sense. Why would you buy a 10-year government bond paying you 1% or less, negative in some cases, when you can buy an inflation-linked real asset with a yield of 4 or 5, and that's 4 or 5 real. So what's so pleasing is that now that everyone has woken up, and you've got governments in the UK, in America now saying, okay, we're going to put up the money, we're going to be doing the spending. Now, what that's going to mean is that our pipeline, and I'm a long-term investor, so that means that my pipeline, 5 years out or so, is going to become increasingly more international. So from our perspective, it's great. It's going to give me more to go for in the long run. In the short term, it has brought people into the market. Now, we already own a lot of real assets. So of course, we're benefiting. We still think the valuation, I mean, my real asset portfolio, the discount rate currently being used on the portfolio, across the portfolio on average, is just below 7%. So when you think at 7% and that risk-free rate, government bonds of 1%, call it, there's a huge gap on valuation. So from my perspective, the more people that kind of wake up and realize this is attractive, now some will wait until projects are completed, others will start buying. As other people come into the market, that's gonna bring down those discount rates. It's going to drive our return. So I think it's great news. I think it's increasingly being rolled out around the world. That is good news for me. It won't all be available for me to invest in, because I want to be at the de-risk side just now. But we're not short of identifying opportunities along the way. So it's kind of nice because we're there already. If I was trying to build a portfolio from scratch, it probably be a bit more challenging. But I said we've had a pretty good run at it. So so good news all round.
Yeah, and I'm just putting on my African hat at the moment. Obviously we're passionate about Africa, having put our money where our mouth is. As a company, having invested heavily in the continent. Your footprint in one of your slides, does that translate? Traditionally, risk equals reward. So you would have thought that in a developing type of environment, such as African markets, I noticed that you had some footprint there. Do you see quite a big return on your investments there when you compare that to, say, more developed economies or developed markets?
So the range of discount rates, if you think about it, the discount rates range between 4% at the sort of the lowest end. It's government backed, out to mid to high teens. And so typically, as you move into your emerging markets, as you move into your jurisdictions where, again, there's those question marks over time, then you're going to see increased discount rates. That all begins to it gets reduced really from where we get involved, because primarily we're interested in operational assets as opposed to assets under construction. At the construction side, they'll be even higher. Most of our African assets will be things such as mobile communication towers, and desalination plants is another one. So there's a new desalination plant being constructed in Saudi Arabia. So about 95% of our underlying assets are operational and 5% is under construction. So in Africa, there's a huge amount going on in terms of renewable energy, but it's not a listed vehicle that I can go and trade. So that's the sort of the gap between what's available to us, as opposed to what's actually taking place on the ground. But just as time passes, at the moment, we're seeing more and more Asian opportunities, investable Asian opportunities, come to the portfolio. But it will roll again as it rolls around the world, and partly because the banks are taking up the running now. So we're seeing more and more of our investments as we meet the management teams. They're now saying, look, we've renewed our loan facility, but because we're building a wind farm, if we hit certain environmental metrics, then we get charged a lower rate of interest. So now the banks want to give green loans. So the companies who are moving into these areas are getting cheaper funding. And so once the banks start to apply funding incentives, or indeed disincentives if it's not green, then you can see even more and more it's just being driven our way. So so look, I think there's lots going on. It's just a case of finding the access vehicles, but it's just a passage of time. So I think you'll see more of those gaps filled in.
I hope you're right, Mike, that it's simply a passage of time, because we are seeing quite a lot of movement in this particular space in this part of the world, which is fantastic. Mike, well, I'm cognizant of time.
I would say one of the things you'll notice, things like your telecommunications. If you think about your Africa, it almost sort of leapt. Mobile communications meant you didn't have to fit your landline, and so with all the tech that's going on, whether it's your distribution centers, warehousing, drone deliveries, there's a lot of things now where Africa can almost leapfrog. And that's definitely the case in sort of mobile communications. Now, I don't know. I just it's unlikely to be a sort of a slow process. It's more likely to tick along and then move forward in a leap. Now, again, when it becomes investable, it becomes interesting for me. So the rest of the time, it's really just a case of reading and talking to as many people as you can and trying to stay abreast of developments.
Well, Mike, I look forward to you joining us in Kenya again to do a kick the tires test.
Absolutely, I hope so.
Yeah. Mike, I'm cognizant of time. I mean, I think I could speak to you all day, but for those of you who have tuned in and have any further questions, please feel free to email me, and we can pull Mike into the discussion to the extent that that I can't answer anything. And I'll defer to Mike in respect of anything that needs a bit of a longer beard than mine. But Mike, I want to thank you again for joining us. We will make this recording available, and we will send that out as well. And no doubt you will get queries from that. Just a reminder to all those attendees that this Mike session is part of our week of our funds week. And tomorrow we've got the Catalyst Global Real Estate Fund at 9 o'clock Central African time. So please join us again. Amri, who's all the way in Mauritius, will be hosting that session. But Mike, once again, thank you very much. Pleasure to speak with you, and we look forward to working with you again in future. So from me here in Naivasha in Kenya, thank you very much, everyone, for joining us. Cheers.
Thanks, guys. Keep well. All the best.